So we met when my own firm, Carlyle, was going public, and they said, well, you need to go see Ron Barron because he buys publicly traded shares when they get public. So I met with you, and I was surprised that you had a pen and you were taking detailed notes. And I said, geez, he's the head of the company. Doesn't he have somebody else doing this? But you were taking notes, and I assume you wrote them up, and then you assessed it, and you gave us very detailed questions. You do that with all the people that are going public that you think might be interesting?
Yeah, everyone who I think is interesting, that's what I do, except I don't use the pen and pencil anymore. Now I use the computer.
Okay, so when you do this, what are you looking for? When you are known for having a long-term hold position. You buy stocks. You told me this when we were getting ready to go public. If you bought our stock, which you did, you hold on for a long time, which you have. What is your theory about holding on for a long time? Why not just sell and take a profit?
Well, first of all, you promised me I was going to make money. That was a promise.
Okay.
And so you said, you can buy my stock. Wall Street is not understanding the value of this business. And the stock was 22 at the time when you went public.
Right.
And now it's 49 and
right.
49.16 or something.
Wow.
And if you compounded, including the dividends, we would have made 16.1% investing with you from the time you went public. And so why didn't we buy and sell? Because if you buy and sell, you pay taxes every time you do that, number one. Number two, what makes me think I'm so smart that I'm going to be able to figure out the exact top and the exact bottom, buy here, sell there. And so that didn't make sense. And plus, I didn't have any confidence that anyone was going to be able to predict what the stock market was going to do. I got that confidence from watching Greenspan say about irrational exuberance in 1996, saying that the market was too high, then the market went up 80% the next 3 years.
So let's suppose you see somebody come to your office, they're going to go public, they want to meet you because you're known to be a long-term investor, and you kind of say, geez, maybe these people aren't as good as I thought. What do you look for when you're looking at a CEO who's coming in to pitch you on his IPO or her IPO?
So about the person, we're looking for an individual who we trust, we think would be a good leader, is a good leader, smart, hardworking, not going to take advantage of us. And the businesses in which we're investing, we think are competitively advantaged. There's something about those businesses that makes it very difficult for someone else to compete against them. So it's competitively advantaged, great people, and there's big growth opportunities. That's what makes us invest.
Generally, when you buy a stock, you intend to hold on to it. But if you're not happy, do you hold on for a year, or 2 years, 3 years? What is the average time it takes for you to say, I made a mistake and I'm going to get out?
It's not the time, it's the fundamentals of the business. And I could own a stock for a number of years and not make a return on it, and that wouldn't bother me as far as making me think I had made a mistake. We were an investor in Tesla for 4 or 5 or 6 years and didn't make a return. And then all of a sudden we made 7 times in a year. So it's not the time that does it, it's the fundamentals.
Right now, many people think the stock market's pretty high, fairly valued, very fully valued, many people would say. So are you nervous about that?
I don't worry about it. And in 2019, December 99 through 2008, were really difficult 8 or 9 years for the stock market. The stock market was down 30 or 40%, 3 or 4% a year for 8 or 9 years. We didn't make a lot of money in that period of time, but we didn't lose. We were up 25% over that 8 or 9 year period of time, which was really terrible for the market. And then since then, of course, we've done very well. And what I think is that, so my big picture of the world, the only thing I am certain of is, I'm sure about our economy, I'm sure about our country, but I think that the value of my money will fall in half every 17 or 18 years. That means that everything I want to buy is going to double in price every 17 or 18 years. So I regard stocks as a hedge against that depreciation of my currency. So I want to own stocks, shares of businesses that can outpace inflation. So that's my simple look. And I think that no one can predict what the market's going to do. No one can predict when it's too high or too low. And I'm just taking the what's coming at us. And when we get opportunities, when the market falls, for example, periodically, like right now, there's been this rotation out of the kind of companies that we've invested in that have done so great for the past couple of years into something that is cheaper. Like, for example, we had an investment in Dick's Sporting Goods. Love this guy, Ed Stack. We invested with him for maybe 8 or 10 years. And then about, I don't know, maybe our cost was $10 a share, and about 3 or 4 years ago, we sold our stock at around $40 or $50 a share. And because I was convinced, or I thought that I didn't want to invest so much in retail anymore, and even though I thought he was a terrific retailer, I wanted to invest in something different. And so we sold. Yesterday, they reported earnings for a quarter of $5 a share for the quarter, and compared to $2.50 that people had expected, and the stock went up 15 or 17 points to $117 a share. And so I sold at 50,
So,
and they're paying a $5 special dividend. And so I don't switch to be fashionable to say, but that's what's outperforming. So this year we're up in the low to mid-teens on average for our firm, our clients. A couple of our mutual funds are up in the 20s. And a couple of them are up in single digits. So we're up. But if I had switched around, if I had been so deft and agile that I could sell everything that I had that I thought was, a little expensive at the time, and buy some things that looked incredibly cheap because they were depressed by the economy cyclically, and then switched out and then switched back, I would have made more money. Would have paid a lot of taxes, but it would have made more money. But I don't do that.
So let me ask you, some people say that because of inflation or other things, worry about the currency. You worry about the currency going down in value every 50% every 17 years or so, something like that.
Yes.
What do you think about cryptocurrencies?
That's a commodity. And so I don't invest in commodities. I don't own gold. I don't own cryptocurrency.
So you're not an investor in cryptocurrencies.
No, and I always worry if you have cryptocurrencies and they get to be real valuable, why is the government going to allow some private enterprises to have control of their currency and their economy? Right? And in 1932 or 33, Franklin Roosevelt, people were afraid of leaving their money in the banks. They took the money out of the banks and they bought gold. Then he made it illegal to own gold. You had to turn in all your gold. Why do I think that same thing couldn't happen? I'm not saying it will, but I would think there's some risk as well.